Welcome to The Close. I'm Matt Scooby. Markets will be closing in half an hour from now. But first, let's get to some of the other stories we are following in the BNN Bloomberg newsroom. Canadian retail sales rose in March, but surging gas prices appear to be increasingly eating into household budgets. Retail sales were up 0.9%, and Statistics Canada estimating sales rose another 0.6% in April. In March, sales were up in 4 of 9 sectors, led by a sharp increase at gasoline stations and fuel vendors. Tenaris is investing in Ontario. The global manufacturer of steel pipe products will invest $306 million in the province to modernize and expand its operations in Sault Ste. Marie. The move expected to create up to 200 new jobs, as well as generate broad economic benefits across Ontario's steel sector. Tenaris operations play a crucial role in supporting Canada's self-reliant steel and energy supply chain. South of the border, Kevin Warsh has been sworn in as the new chair of the Federal Reserve. Warsh says that he will lead a reform-oriented Fed, adding that goals will be pursued with resolve. U.S. President Donald Trump says America's future is unlimited with Warsh at the helm, and highlighted that he wants him to be completely independent.
Kevin has spoken often about the need to restore the Fed's integrity by returning to a proper focus on its two functional and really fundamental responsibilities, maintaining price stability and low inflation. Honestly, I really mean this. This is not said in any other way. I want Kevin to be totally independent. I want him to be independent and just do a great job. Don't look at me. Don't look at anybody. Just do your own thing and do a great job.
Let's have a look at the markets before things close for this Friday. The TSX hitting a new record today, topping its all-time high that was reached back at the beginning of March, led by financials and tech stocks, TD, Shopify, a couple of the stocks that are having big days, but again, going to end the week in the green as well on the TSX. South of the border, also a pretty good day. We have seen the S&P 500, at least at this point, and a couple of them floating right now, flirting with another record too. The Dow up over 340 points so far today, almost 0.7%. But again, a lot of green right across the board again today. Well, Prime Minister Mark Carney is calling for national unity after Alberta Premier Danielle Smith announced plans to move toward a possible separation referendum this fall. Carney says Alberta is, quote, essential to the country's future. For more on what it could mean for the markets, we're joined now by Jay Bala, CEO and Senior Portfolio Manager at AIP Asset Management. Jay, thanks for being here.
Hey, no problem. Thanks for having me on.
Let's start with this news out of Alberta, too. It feels like a referendum to maybe have a referendum after the petition failed, at least right now. But just wondering right now, with these talks and where things stand, what's your big picture view of what this could mean for the markets?
Sure. I mean, look, at this point, you're right. Look, it's a referendum about having a referendum. And so right now, I don't think anybody's taking it, or I guess the markets aren't overly concerned about it. The government's effectively kicked the can down the road. I think the real shock may come if they vote to have that referendum later on this year, in which case I think the markets will start taking it a bit more seriously. But at this point, I think it's just, I think the markets have sort of just pushed it off to political showmanship more than anything else.
It feels that way. It feels like Premier Smith is trying to at least, for now, negotiate and get through some of this without alienating any of her constituents. But I'm curious to, if we get to this point, though, Jay, and we get down that road, like you talked about, too, whether we get into the fall or not, because Premier Smith has also been negotiating with Mark Carney, too, as well. We talked about the new pipeline and what that could mean. But, the impact that we could see on the loonie, the impact we could see on Canadian bonds, investor confidence, if we get to that point, are we going to be concerned that all of those will start to fade?
I think to some degree. I mean, look, a province looking to separate is never good news. And if it's a serious discussion, it's never good news at all. But I think, look, broadly, I mean, I still am of the view that I think the vast majority of Albertans would like to stay with Canada. I think you've always got, sort of extremist groups that want to do things their own way. And the reality is, even if it came down to a point where they somehow managed to separate, every agreement they signed with us with regards to a pipeline or anything else would would probably, I would assume that, someone like Carney would probably say, look, we'll build the pipeline contingent on the fact that you're still part of Canada, right? And if you're not part of Canada, well, all those agreements suddenly become null and void, I would think, right?
I'm curious to your thoughts with the oil sector, right, as well. Oil and gas, it plays such a big part in the Canadian economy, too, especially coming out of Alberta. We've seen, the sharp rally from those stocks, mostly based from, the price of oil when it has been, with the conflict in the Middle East, at least in the last little bit, too. What could, again, the impact of that, and even if, there is a referendum or not, but, could we see that if we get to the fall, are we going to see an impact there at all, or this is still going to mostly be globally driven no matter what is happening in the province of Alberta?
Yeah, look, I think it's going to be globally driven no matter what we see in Alberta. And there's also a reality, right? Oil at $100, maybe everybody's thinking, hey, referendum, hey, maybe leaving. If we had the referendum when oil was $20, I think people would make a vastly different decision, right? It's always a function of these prices. So, keep in mind, it wasn't too long ago when, oil prices were $20 a barrel and dropping further and people thought it was the end of an era, right?
Yeah, it's very true. It's a good point that you make about that. Let's shift to the macro picture, to bond markets, right? Still focused on government spending, too, at least for right now. Talk about the concern, what's driving that, at least at this point.
Yeah, look, I think people talk about a lot of things, but the reality is it's fiscal discipline, right? Keynesian economics is based on the concept that, during a recession, a government can borrow money and inject it into the economy. During good times, you would basically use your excess tax returns to pay down that debt. Unfortunately, we haven't seen that across the Western world. We certainly haven't seen it across the G7. It was, hey, it's COVID, we're going to spend lots of money and we're going to borrow that. Hey, it's good times, we're going to keep, borrowing money and keep spending it into the economy. And then we're going to pretend we're shocked when inflation numbers go up, right? The reality is, everybody needs to get their fiscal house in order. Sadly, Canada's probably the best of the worst in terms of, what our deficit rates are. We're running deficits too. It's just not as bad as the U.S. or, parts of Europe or Japan. So, sadly, that's the best we can do right now, which is, we're the best of the worst.
I'm curious your thoughts, too. We talk about this for right now, and you mentioned that, and the TSX hitting a record high, right? So we have on the markets, too, as well. You look south of the border, too, up in the green, expected for an 8th straight week, to have another winning week in a row, while consumer confidence, and you look at what's coming out of the States in a recent survey, at least for right now, that they don't think the economy is necessarily in good shape. So give me your sense of why we had such another record day, too, on the TSX, and what this could mean here for the next, coming weeks.
Sure. Look, the way you got to always think about it is that the equity markets and the debt markets are fundamentally connected, right? So if I'm a government and I'm spending irresponsibly and I'm borrowing lots of money and creating inflation and I'm dumping that into the economy, so what as an investor is that cash isn't going to be worth much, right? Your cash is going to keep declining in value, and so you run to the fastest place where you can have some security, which is the equity markets, right? You basically start creating asset bubbles, and the fastest asset to buy is a stock, so the stock market rallies, right?
Mm-hmm. And you're expecting that, at least for now, given the uncertainty that we still are seeing in the Middle East. I know investors have been clearly watching it closely, whether they've been, impacted less on the headline news every day. We saw some wild swings at points, but given what we're seeing in the Middle East, do you see this rally continuing next week?
Yeah, I do. Look, at the end of the day, if you take out the equation of, I guess, the shorter term issues in the Middle East, the North American economy is still very healthy, very robust. Outside of the fiscal spending, which needs to get reined in, what you are seeing is you're seeing tremendous growth in a new technology, which is, AI and AI-related stocks. And I think, at the end of the day, AI is the future. It is as important to our economy as the Industrial Revolution was to economies, 200 years ago. And so, I think that's going to continue to grow. I think, if you look at AI and AI infrastructure in particular, this is the largest infrastructure spend we've had in human history. So, look, I don't think, I don't think the stock market's going anywhere. I think it's going to continue to be bullish on a go-forward basis.
Jay Ballas, CEO and Senior Portfolio Manager at AIP Asset Management. Jay, appreciate your time today. Thanks so much for this.
No problem. Thanks so much.
Well, the CRTC is formalizing new rules that will force streaming giants to invest more in Canadian content. It's a move that's going to have grander geopolitical implications. We're going to break it down when we come back. Stay with us. The CRTC has unveiled a major new framework for online streaming services that will require companies like Netflix, Disney, and Spotify to devote more of their Canadian revenue to supporting domestic and Indigenous content. Joining us now to break down the grander implications of the new framework is Rod Butler, VP of Content and Regulatory at the Canada Media Fund. Rod, thanks for being here.
Thanks a lot. Happy to be here.
Let's get into this, shall we? There's a lot of, I want to get to the criticism maybe in just a second, especially from south of the border for now. But give me your thoughts, big picture here, on what this means, because there's been a lot of talk about modernization. We have to get in bringing us up to speed in the digital age right now. But give me your thoughts on the decision as a whole.
Sure. They're trying to update a system while not pulling out all of the existing supports overnight, which makes sense. So balancing modernization and stability is always going to be a delicate dance. It's early days. There's a lot of dust to settle. A lot of folks are poring over the nuances of the decision as we speak. From the CMF's point of view, there are now more entities that are contributing funds to our industry. Making any TV show in Canada it's a patchwork quilt of financing. So now there are more patches in that quilt.
For you too, I think maybe a lot of people taking issue, or at least a lot of the streaming giants and otherwise, with how big the raise was, right? Going from 5% of revenue all the way up to 15%. We're tripling it for those costs. Is that what needed to be done? Is that too much in your view? Not enough? Where do you stand?
I think it was always the plan is our view. When the CRTC announced this consultation in May 2023, the information and the materials framed this process as happening in stages. So the initial 5% base amount, that decision came out in June 2024. That was never going to be the final amount, and they forecasted that. So it was always going to be a regime of an initial base amount of money, a flexible financial requirement that would encompass a further expenditure amount on CanCon, like they've just done, and then the intangible requirements, again, like ways to promote Canadian projects. So building upon that initial base amount of 5% has been the plan from the jump.
And talk about that. We talk about CanCon and just how important it has been at different points, whether it's in the spotlight at the Oscars too, which we have seen too, which I think was great for the Montreal filmmakers that had that. But outside of that, all it filters down, because we're not talking clearly about smaller companies. You're talking about giants. This is going to be a lot of money and filtering in, and can only, I'm assuming, at least from your point of view, to be good for content, for Canadian content too, in this country.
I think so. People watch TV in a lot of different ways, and some of those ways paid into the pot to enable our industry to make more things, and some of those ways did not. So change is going to take change. The new way will never look like the old way, and there's going to be new elements that we will all have to think about and adapt to. But the CMF feels the CRTC acknowledged that a minimum amount of existing supports and pillars have to remain. So again, early days, but on initial reading, this decision feels less prescriptive, it feels more flexible, and it just feels like there are fewer sticks and more carrots.
Is there ever going to be a world, Rod, possibly where a Disney, where a Netflix or otherwise looks at this, and I'm not saying it's necessarily going to be that 15% right now, and says, we're not going to do this, and we're not going to do this in Canada too, which could be a big blow clearly to consumers in this country. But as we watch the modernization, you watch those numbers start to change a little bit, do you believe that one of them and one of the big ones could be like, no, we're not going to do this, we're out, and we're not going to offer our content in Canada?
Listen, I think those companies are in the best position to answer. I think there's a lot of plates being juggled in the air on the regulatory side, the judicial side, and the political side. So there's obviously current appeals going on right now from previous CRTC proceedings. I would say, though, that Canada has always punched above its weight. We are a very strong market for a Disney or a Netflix. So I think where a lot of partners in Canada are hoping is this is obviously a change, but it's an opportunity to make new connections and new bridges. And when you think about what Canada has to offer, the heated rivalries, the Schitt's Creeks, the North of North, I think if the Disneys of the world were smart, there are new markets and new opportunities here where a lot of us can, again, find a way to manage industrial autonomy and cultural autonomy at the same time.
Let me ask you if there are any concerns, too, about dropping the P&I requirements, too, at least at this point.
I think when the CRTC forecasted this, they asked a lot of questions around this. Everyone got very nervous. I think, they are trying to ultimately find some level of balance. So if programs of national interest are no longer a requirement, part of the CMF's mandate is to fund kids programming and documentary and drama and variety and performing arts. And so while there may not be a requirement anymore, there's now more new money coming to the CMF to fund those types of projects. So it's more about being less prescriptive, giving players more opportunities to make the content that they want to make. I do think in the short term, though, again, this is not going to be business as usual, and it's going to take, a reevaluation of business models to try and operate in this new world.
And for you too, and the larger broadcasters in this country too, Rod, watching that come down, just touch on those numbers and what it could mean here in Canada as those numbers are going in the opposite direction.
Well, I think the regulatory burden in reducing it was part of the policy direction from the government of Canada to the CRTC at the beginning of this process. So the business models of traditional broadcasters have been upended for the past 15 years at least by entities that did not have the same requirements to contribute to our system. So there's now more money coming into Canada for content creation. So I understand the motivation for lessening the obligations on one party as new parties are brought into the fold.
Rod Butler, VP of Content and Regulatory at the Canada Media Fund. Rod, appreciate your time. Thanks so much for this.
Thanks very much.
Well, Canada's retail sector saw a solid rise as higher gas prices lifted spending. We're going to break down StatsCan's latest report after the break. Canadian retail sales rose 0.9% in March to $72.7 billion. To break down what it means for the Canadian economy, we were joined earlier by Robert Kavcic, Senior Economist and Director of Economics at BMO.
When you have a spike in pump prices like you did in the month, that directly flows into retail spending, not because consumers want to pay more. It's just that's the amount of money flowing out of their pocket, right? So that gets captured in the retail numbers. And we and analysts, the Bank of Canada, are immediately going to scrub that out and look past it and say, okay, what are spending trends across other categories? Quite a bit flatter. More importantly, what is spending doing in volume terms? How much physical stuff are Canadian buying? And that was down again in the month. And if you look back over the last 6 months, the last 12 months, the volume of consumer spending in Canada has been pretty sluggish overall.
Can you dive into that deeper about the spending in other categories that you say was pretty flat and all your other findings that you were looking into in terms of just how much Canadians are spending and where?
Right. So you get quite a bit of upward spending pressure in areas like groceries and gas, and that's mostly driven by inflation, right? Discretionary spending, whether it be autos, which have come back relatively well, or other categories, whether it's general merchandise, sporting goods, consumer electronics, things like that, the volume trends have been quite a bit flatter. And reason being here is that Canadians are kind of faced with this pressure where a lot of the essentials or the non-discretionary items are taking a bigger share of their wallet, whether it's, going to the grocery store to buy food that's rising 5, 6, 8% per year in price, or even things like mortgage payments, which are resetting higher at a steady rate right now. That's, taking discretionary dollars out of the Canadian wallet and as a result, a little bit less spending elsewhere.
How concerning is that for real economic growth?
Well, it's a headwind for sure, and it's a headwind that's probably going to be persistent for 2026. So you can look at the issue with gas prices. Maybe it's temporary. It's turning out to be a lot less temporary than a lot of us had hoped, 2 or 3 months ago. The longer that persists, especially into the summer, the more and more that's going to kind of hold back those discretionary items. That could very well go away really quickly, though, right? Like, as sure as we're sitting here, we could see, a deal between the U.S., Iran, and a very sudden reversal in gas prices, which would help and take some stress off. The other side of it, on the mortgage side, we're going into the middle of the year, and we're going to have probably, more than 1.2 million mortgages renewing in Canada this year, and the peak of those renewals is going to be coming around the middle of the year. And keeping in mind, a lot of Canadian households are coming off of 1.5%, 2% mortgage rates, rolling into rates that are more like 3.75 or 4%. They're going to make those payments every month, but they're going to do so at the expense of some other discretionary items. And that's a headwind that we know almost for sure is not going away in the next 6 to 12 months or so.
Mm-hmm. How does all of this fit into the Bank of Canada's decision making right now, moving forward?
Well, so there's some push and some pull on the Canadian outlook, right? So we're getting quite a bit of fiscal stimulus. The flip side is that areas like housing and consumer spending specifically are still relatively slow. And from the Bank of Canada's perspective, this kind of just reiterates that we're in an environment where growth is running, probably 1.5% or so in the first quarter, generally below potential overall. And for the Bank of Canada, I mean, this just reinforces that they should be pretty comfortable on hold here with rates at, the low end of what they would consider neutral. There's pricing in the market for, upwards of 50 basis points of rate hikes later this year. Given the macro fundamentals, given what we're seeing with growth, given what we saw in inflation earlier this week, which was pretty cool. We just don't see the case for rate hikes in the near future at all, to be honest.
Does it depend, though, and I know you've talked about this a lot over this conversation, is just how long this conflict in the Middle East continues on? Like how long we're seeing elevated gas prices, for example. Would that maybe change your view heading forward or in the early months of 2027?
Yeah, it's something the Bank of Canada is being especially cautious about too, right? Especially coming out of a period where we had a number of years of well above target inflation. They don't want to allow inflation expectations to get reinforced again. And look, persistently high gas prices is an easy way to do that because pretty much every Canadian sees those prices every day on the way to work, right? So the bank will guard against that. The good news for the bank, though, is that outside of gas prices, we've actually seen pretty impressive progress on inflation to the downside, and especially on core inflation over the last 3 and 6 months. So they have that working in their favor. And maybe contrast that to the Federal Reserve, where yes, we're seeing the same gas price shock, but underlying core inflation fundamentals are actually moving the other way. They're actually accelerating a little bit. So yes, the longer it lasts, the more likely it is the bank gets more concerned about it. But given everything we see on the ground right now, we just think the bar is pretty high for them to actually go ahead and raise rates.
That was Robert Kapsik, Senior Economist and Director of Economics at BMO. Well, up next, the closing bells on Bay Street and Wall Street. Stay with us for that. Here are the closing bells at the NASDAQ. Maywood acquisition ringing the closing bell. And the New York Stock Exchange, it's U-Haul Holding Company that's ringing the bell today on this Friday. You're watching The Close on BNN Bloomberg. I'm Matt Scooby. Here's how we close the day on Bay and Wall Street. Well, the TSX hit a record high today, topping its previous all-time record from early in March, getting up over the 34,400 mark to it, topping 34,500 at one point over the course of the day today. Up, again, a very big day in Toronto right now, pushed upwards by financials and tech stocks, too. On the U.S. markets, another good day, a lot of green, too. We talk about, again, another record, the Dow Jones setting another one, record high, up almost 300 points on the day today, close to 0.6% increase, and all the green that's there. The NASDAQ, longest winning streak on the NASDAQ since April of 1992. And then on the S&P 500, not quite necessarily in record range, but still flirting with it once again. Projections for the S&P look good, but we've talked about it, a lot of green over the course of the day today. Let's have a look at some of the big moves of the day as well. Leading the TSX on this Friday, BlackBerry is certainly one, which is, again, day today. NFI Group also on the move, and MDA Space is also having another big day today, too. It did at least a wrap up this week as well, as we looked at a couple of those big movers over the course of the day today. On the flip side, CAE is falling today, certainly being hit hard by what's happening in the conflict in the Middle East. We're going to have more on that in a second with Bloomberg's Stephanie Hughes. Perpetua Resources also on the losing end today, down at least for right now, down just slightly for today. And Triple Flag Precious Metals also taking a hit today, at least minimally for now, but those are at least some of yours. The notable stocks, too, on the American markets today. IMAX is up on reports that the firm is exploring a possible sale today. Zoom also up as the latest results beating estimates, and it raises its sales and profit forecast, too. And Estee Lauder up after the company announced it terminated discussions regarding a potential business combination with Puig. So those are your movers on the day today. For more, we are joined now by Bloomberg's equities reporter, Stephanie Hughes. Stephanie, talk about CAE dropping today, at least for right now, too. Brought the share price to a year low. Take us through what happened today.
You bet, Matt. Yeah, happy Friday. And so CAE shares fell as much as 14% today. It's a big double-digit drop for the flight simulator, which marked its biggest intraday drop since April 2022. So it's been a few years since we've seen a move of this magnitude for CAE. And like you mentioned, it brought that share price to its lowest point in about a year. So there's a few things going on with the earnings report this time around. First off, the adjusted earnings per share did come in line with consensus analyst expectations. So it wasn't so much that it missed expectations, but there's a few things going on. So at TD Cowen, they acknowledged that the fiscal 2027 guide was a bit lower than expected, but probably not surprising to the team given the company's transformation plan and the Middle East conflict impact. So there's a lot of uncertainty there. The analyst at TD Cowen, Tim James, added that the highly anticipated long-term 2030 targets do offer some upside, but 4 years from now could lead the market to factor in things like the fiscal 2027 weakness, and that would be factored into the short-term stock reaction, which we're kind of seeing right now. So the CAE's chief executive officer, Matthew Bromberg, laid out a plan to boost the company's operating income by about 30% or more by 2030 in a strategy that would really leverage more defense-based clients. It's a really growing part of their segment. And a lot of other companies are trying to leverage more defense spending just generally. The BMO team said that the longer-term outlook surprised the market, being skewed a bit more conservatively and largely hinged on cost savings rather than really focusing on organic growth. So right now, it doesn't seem like traders are all that convinced, or maybe they're skeptical. Maybe it's that 2027 guidance that's really getting them concerned there. But it's a matter of CAE convincing investors that it's going to make well on these plans and get on the right track, Matt.
And you know, Stephanie, talk about, reading about a reset year, right? We're trying to be in a reset year for CAE, at least CAE rather at this point too. Now, moving forward, you talk about that lack of investor confidence too. I think it's sort of timeline to try to get it back. The possibility of the next 6 months to a year going to be vitally important for this group.
I think so. It's tough to tell, right? It's relative. From what I understand, it's a relatively new executive team, and they are trying to. They've made some changes over the past couple of quarters. So it really does hinge on whether they can make their strategy work, and then really make the most out of this stronger federal defense spending plan. And you're not only just seeing that in Canada, but more globally too as well.
Yeah, seeing billions of dollars right up for grabs right now, at least for now. So Bloomberg, Stephanie Hughes, appreciate the insight today. Stephanie, thanks so much.
Thank you.
Well, coming up, Kevin Warsh sworn in as the next Fed chair. We're going to have more on that and some of the impact and the fallout coming up after the break. Kevin Warsh has been sworn in today as the 17th chair of the Fed. U.S. President Donald Trump says he wants Warsh to do his, quote, own thing as he takes over at a time of heightened global uncertainty with tensions still ongoing in the Middle East. We're joined now by Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Chad, thanks for being here.
Well, thanks for having me.
You know what? Let's start with Warsh too, right? Stepping in for him, it's been widely expected and anticipated. You know, especially given the strained relationship between Jerome Powell and Donald Trump. So, give me your sense today. How are markets interpreting that shift so far? Have we seen any movement?
Well, I think that he's a terrific pick for the markets and for the U.S. economy. His viewpoints are somewhat traditional. They were at odds with Ben Bernanke, but nonetheless, we believe strongly that going forward, that he will be able to lead the Federal Reserve in quite a conventional manner and not disrupt the markets.
Yeah, there's a lot going on, right, Chad? Clearly, when it comes to geopolitically with the conflict in the Middle East, you have the U.S.-China relationship. We have the inflationary pressures as well that we're seeing, especially from the increase in gas prices. We know that this is a Donald Trump pick, at least, very straightforward, that he has a very friendly relationship with the U.S. president right now. What are you expecting? Could we see a conflict in any way, or what are we expecting from him out of the gate here for the first few months?
Yeah, I'm a bit scratching my head because I think that he's an independent thinker, and I don't think he's going to follow the wishes of any president for that matter, which really bodes well for the financial markets. We're not anticipating that he will be lowering rates in an aggressive manner. In fact, I think that he's going to sit on his hands for the next 3 months or so and just watch to see how financial conditions as well as inflation play out.
So you want, again, for the next Fed announcement, we're not expecting any movement. You would say at least for the next few, possibly even until the fall, we won't see anything?
I believe so. I think he's going to stand pat, and I believe that the whole group at the Federal Reserve, the voting members, will also fully back that opinion.
And give me your sense, too, as you talk about the other members of the Fed, too, with a new chair and with Warsh in particular, is this going to change any of the dynamic? We know and have reported clearly on what's happened with Jerome Powell and what has happened with the new building and otherwise. But outside of that, just talk about the relationship of how you have a new leader come in, especially in a time with so much uncertainty and what's happening in the world right now.
Yeah, so he's very different in his viewpoint. And one in particular has to do with the Fed balance sheet. He was at odds with Ben Bernanke back in the day when the Federal Reserve was actually increasing their balance sheet. The Federal Reserve would typically do that when financial conditions would become a little bit, let's just say, untethered. Where credit spreads would widen out, you could see that the Fed would then hit the gas pedal, increase their balance sheet. Chairman Warsh is not going to do that. In fact, I believe his focus is going to be to reduce that balance sheet over time, not immediately, but just over time in a gradual manner. And I don't believe that Fed put, that famous phrase, the Fed put, I don't think that is in play anymore. So again, I think this is a really healthy move in the right direction for the financial system and also for the Fed.
Yeah, certainly going to be interesting, I think, to see how it plays out and how long we've been talking about this happening. Want to get your thoughts too, Chad, as well on the markets too. We talk about the Dow hitting another record today. The role that AI has played, at least recently, too, in some of that drive, some of that rally, and what we have seen. What is your expectation with what is looming in the Middle East? Clearly, it feels like investors, at least from the way I see it right now, a little less pressured, a little less influenced by the everyday headlines about what is happening, but certainly feeling like there is at least some sort of positivity that we could see that conflict resolved at some point soon. What's your take? Where do you stand on things right now?
Yeah, it almost seems like you're in bizarro world because with all of these kind of uncertainties, you think that would be pricing the market lower. But in fact, it has not, due in part because of this gigantic surge of capital CapEx into AI-related infrastructure build-out. That's really what's been moving the market over the intermediate term, and that's what's also moving earnings. So with that said, we believe that the market's pricing in a positive type of outcome in Iran. We tend to be somewhat more concerned about it than the overall market. And also, this actually has played a massive role in the types of companies that have been really outperforming and leading the market higher.
And talk about that, just that concern too as well, especially being so dependent on AI. We have seen, some of the roller coaster maybe a little bit thus far, maybe in the last few months or so. But as we continue moving forward, what are your concerns and what level are they at right now?
Well, okay, we believe strongly in AI. We believe strongly that GDP growth will continue to kind of move forward. But what you've seen happen within the market is that high volatile stocks, high beta stocks have been a majority of the return for not only the S&P, for the equally weighted index, as well as the value indexes. So we believe that is going to perhaps subside over time, and you'll start to see a broadening out in regard to higher quality companies, lower volatility companies. Those companies today are exceptionally cheap. You've had 3.5 years of a low quality rally in the markets in the United States. That has not happened even going back to 1990. So there are massive or exceptional opportunities in lower multiple companies.
Chad Morganlander, Senior Portfolio Manager at Washington Crossing Advisors. Appreciate your time today, Chad. Enjoy your long weekend.
Thanks for having me.
Well, coming up, rising oil prices are starting to hit your grocery bill with new fuel surcharges emerging. What does it mean for independent grocers in particular? We're going to have more reaction to that when we come back. Rising oil prices linked to Middle East tensions are pushing new fuel surcharges and food price hikes. While major grocers say they are pushing back, independent ones warn that they lack the leverage and are feeling the pressure as a result. For more on this, let's bring in Gary Sands, Senior Vice President of Public Policy and Advocacy at the Canadian Federation of Independent Grocers. Thanks for being here.
Glad to join you.
Yeah, Gary, we've talked before, and it felt like we knew this was coming at some point, especially if we did not have an end to the conflict in the Middle East. But you in particular are saying that some of these pressures are not being applied evenly, especially when it comes to the big chains. Take us through the thought process and explain to us why.
Well, the suppliers, and that's the food manufacturers that supply the grocers with the products that your viewers, consumers are buying, have been sending out numerous letters, notifications of cost increases that they have attributed, understandably, to rising fuel prices. And they've imposed either an increase in costs or they're putting in place a fuel surcharge. We understand the rationale for that. I mean, anyone who's pulling their car up to a gas station to fill up understands what's going on, and obviously that's impacting the food industry as well. But the problem we're having is that not everyone's getting those notices. In some cases, some of the chains are saying they're not even receiving the fuel surcharge notices, and in other cases, they're saying publicly that doesn't matter if we get them, we're not accepting them, and that should be a concern to governments and should be a concern to consumers in general. That kind of unfair application of increases that are unavoidable are being passed only on to one sector of the retail grocery industry.
Yeah, we've obtained a couple of those letters, and especially some of the timing, that in some cases, right, giving only days notice that something was going to change, that those costs were going to go up very quickly. We know that margins in the grocery industry, even for the big stores are so thin. But especially for independents, I'm assuming that those costs, if the independents have to face them, are going and likely have to be passed on to the consumer.
Yes, I mean, I can't say what all independents will do, because independent means exactly that. They're independently able to make their own decisions, but really they've only got three alternatives. One is to increase prices. The second is to reduce their margins even further. An overall margin of independent grocers is about 2%. So you're getting into very precarious territory there. And the third option is you're looking at having to reduce or scale back any in-store investments which are necessary to make to keep your business going. It's one of the three. So none of those scenarios are very encouraging or good for the industry or for consumers.
When we look at it too, and in particular for independent grocers, there are a lot of times in smaller communities and in smaller towns that they are the only store. They are the only grocery store. They're the only spot that a lot of people can go to. If we look at those margins sinking, if we look at the costs increasing as much as we're talking about too, is there the possibility that we're going to slowly start to see, and maybe not even slowly or possibly all at once, some of these stores really start to close up shop because they can't face any more increases?
It's a good question, and you're absolutely right. We have about 6,900 independent grocers in Canada, and they're in all areas, urban, rural, remote, but a lot of them are in rural and remote communities where the size of the community is just not large enough to support a chain. So they're the only source of food for the people in that area. So I would just point out too that even before this issue of the fuel, the rising fuel prices due to what's going on in Iran started to arise, costs of transportation for food to those areas in Canada is already higher. And that means the cost of food is already higher in those areas. So the impact of these fuel surcharges and the rising costs is going to be more disproportionately significant in those areas. And I think if you're not talking about, if it's not closures, I think you're certainly treading into the area of food security where, the price of food could simply become unaffordable. And that should, again, be a concern to government. Again, I don't want to point the finger at suppliers. We understand what's driving up their costs, but we are pointing out as loudly as we can that we have to have fairness in how they're applied. And I'll give you just if I can, just a simple example of where there's a disparity in the approach. On March 31st, Maple Leaf Foods, well known to consumers, sent out a notice to retail grocers notifying them that they would be implementing a fuel surcharge effective April 6th. Now, if you look at the calendar, you'll see that was really only 3 business days. I can tell you without fear of contradiction that if Maple Leaf Foods sent that kind of notice saying their costs, they were imposing a fuel surcharge and their costs were going up within 3 days. If they sent that to Loblaws or Walmart or Metro, all I can tell you is they'll keep the car running for them in the parking lot while they run in to have that conversation because it's not going to be a long meeting. They wouldn't accept it. Mm-hmm. And Maple Leaf knows that. So really, in essence, what they've done and what others are doing is they're imposing a fuel surcharge and rising costs only on independents. And surely, as a country, I'm hoping that we'll say this is not right.
Gary Sands, Senior Vice President of Public Policy and Advocacy at the Canadian Federation of Independent Grocers. Appreciate your time today, Gary. Thanks for this. Thanks for having me. Well, up next, a closer look at the economics behind Canada's World Cup cost and what taxpayers could be on the hook for. That's ahead. Canadian retail sales rose in March, but surging gas prices appear to be increasingly eating into household budgets. Retail sales up 0.9%, and Statistics Canada estimating sales rose another 0.6% in April. In March, sales were up in 4 of 9 sectors, led by a sharp increase at gas stations and fuel vendors. Tenaris is investing in Ontario. The global manufacturer of steel pipe products will be investing $306 million in the province to modernize and expand its operations in Sault Ste. Marie. The move expected to create up to 200 new jobs, as well as generate broad economic benefits across Ontario's steel sector. Tenaris operations play a critical role in supporting Canada's self-reliant steel and energy supply chain. Well, Kevin Warsh has been sworn in as the new chair of the Federal Reserve. Warsh says he will lead a reform-oriented Fed, adding that goals will be pursued with resolve. U.S. President Donald Trump says America's future is unlimited with Warsh at the helm and highlighted that he wants Warsh to become completely independent. Some of the changes Warsh has promised for the central bank include shrinking its balance sheet and establishing a new framework for analyzing inflation. Well, we are just weeks away from the 2026 FIFA World Cup coming to Canada, and a new report from the Parliamentary Budget Officer suggests the public cost could top $1 billion. This is raising questions about cost overruns, economic impact, and value for taxpayers. For more, let's bring in Dwayne Rockerby from the Department of Economics at the University of Lethbridge. Dwayne, thanks for being here.
Well, thanks for having me.
$1 billion, it's quite the mark to think. And, you know, this country certainly has a history of cost overruns for big sporting events. I think back to the Montreal Olympics, I think in particular. But give me your sense after seeing this report about what it could mean for taxpayers right across Canada.
I think it's a very good report, actually. There's a lot of good figures in it, and the costs seem to be in line with what we've seen in past World Cups. So I think, however, the big fly in the ointment is what's going on in the Middle East and energy prices and inflation. And for sure, these costs are going to come in higher when it's all said and done.
Yeah, no one could predict what was going to happen, I think, right, with that conflict between the U.S. and Iran, and that we're still feeling the effects of that, and it's clearly going to drive them up. But, you go back, Dwayne, and look at some of the initial estimates, right? Remember that, in Toronto, it was $25-30 million for taxpayers that they were going to host 5 matches, understandably, an expanded tournament. But, give me your sense, is it just the conflict in the Middle East that has caused this, or where else are we looking at it? Because the price tag for Toronto alone now over $300 million.
Right. No, those initial cost estimates were wildly too low. And these things always come in. The Olympics, the World Cup, mega events, when you combine them with local infrastructure, transportation costs that are needed, and security costs and other costs, FIFA and Deloitte always sort of underestimate these things and greatly overestimate the benefits from hosting the World Cup. Having said that, though, there's an old saying that says if you want to be invited to parties, you have to host parties. And if Canada's objective is to become some sort of world soccer power, this would definitely be a step in that direction.
Yeah, it certainly is hopefully going to be. I think for soccer fans, hopefully that is going to be the case clearly come this summer. Security costs, I think, we have seen the government step in to offer some support when it comes to security costs, but certainly feels that is playing a big role here in what we were seeing in some of these inflated numbers.
Absolutely. The security costs, particularly with what's happened in the last year in the world, three attempted assassinations on the U.S. president. And hooliganism at soccer games and these sorts of things, which doesn't really exist in other sports. There's a great concern by FIFA that this could they don't want it to turn into something ugly on worldwide television. And so you have to provide the security costs, and you're just going to have to pay these costs. That's kind of the way it is.
For you two, Dwayne, and looking at this right now, and I'm curious your thoughts about the economic benefits from this, because some of the recent reports that we've seen, when you look at, it's not necessarily every host city, but there are a number of them across North America, whether it's Canada, the United States, or Mexico, but where hotels are saying, we're not seeing the bump that we were going to see. Airbnb, hosts saying that, we're not booked up necessarily at this point. Ticket prices, fans have been priced out of the market in some, including, in Toronto, where it is very expensive, to go see a match, let alone go and try and see the Canada match. Do you believe that we are going to see, I'm not saying we're not going to see clearly, a lot and millions of dollars pour into the economy, but give me your sense of where things stand just because of how expensive life is for everyone right now.
Well, in 13 of the last 16 World Cups, they've been economic losers in terms of economic benefits. And you could say the same for the Olympics. And the problem is that the benefits are not lasting. We call this the honeymoon effect in economics, that generally, Deloitte said there's going to be 24,000 jobs created from this and mega infrastructure improvements. But generally, after a year or two, those benefits dissipate very quickly, and this thing is all forgotten. So, based on economic studies that are available for many, many of these mega events, they're money losers both for government and for the net benefits to the country. But again, however, having said that, If we have the Canadian Premier League now, we're trying to develop soccer in Canada. And, if we want to participate in any further FIFA events, you just have to put these things on and pay for them. But as far as the net benefits go, I'm not optimistic on this.
Yeah, it certainly doesn't feel that way. Now, taxpayers are going to be on the hook for a lot of this, I think, clearly at multiple different levels. Do we expect, do you expect to see any uproar? Not that there's much that taxpayers can do necessarily at this point, but especially when it comes to future events, it feels like.
Well, this will be the barometer, I think, for future events. Things like the Olympics, a future World Cup is not likely to come for a long time. But certainly, even the Winter Olympics in 2010 in Vancouver, we don't even know what the net economic benefits were. It wasn't really followed up on very well, and it's very, very difficult to calculate. There's many items to include, as well as many costs that are ignored. For instance, I always say $1 billion is the new million. But however, there is an opportunity cost to that money. Could you use it for healthcare? Could you use it for education? And I think the general population who are not soccer fanatics would probably say that it could be better used elsewhere.
Yeah, always going to be, it feels like, the argument from those who are against some of the big events like this, at least at some different points, including this summer. Dwayne Rockerby from the Department of Economics at the University of Lethbridge. Appreciate your time today, Dwayne. Thanks so much.
Oh, you're welcome. Thank you very much.
Well, coming up, our next guest has one of the largest collections of Ferraris in North America. Now a real estate mogul, he got to start trading hockey cards. We're going to have more on his story, what's happening with him for F1 weekend in Montreal, coming up after this. The CRTC is raising the costs for streaming companies to support Canadian content. CTV's Abigail Beeman has more on what it could mean for Canada-U.S. trade talks.
This will triple the amount of money streaming companies will have to pay when some are already battling the current rules in court, and the whole issue is a thorn in the side of Canada-U.S. trade talks. As part of an effort to bring broadcasting rules into the digital age, the Canadian Radio, Television and Telecommunications Commission says digital streaming giants such as Netflix and Disney will have to pay 15% of their Canadian revenue to support programming in this country. That was previously set at 5%, but no one has benefited from the money, which is sitting in trust while the streamers fight the decision in court. Meanwhile, the Trump administration has long railed against the Online Streaming Act, calling it a trade irritant on a list of contentious issues ahead of a July 1st deadline for a review of the Canada-U.S.-Mexico free trade deal. As for traditional private broadcasters, including CTV News, the CRTC has lowered the amount to 25% of revenues with a whole host of new rules about how that money is spent. The old amount was between 30 and 45%.
That's CTV's Abigail Beeman reporting for us. Well, while most people see cars as a depreciating asset, our next guest says his cars are an investment. He currently owns 38 Ferraris, which are worth over $100 million. Joining us now is the owner of one of North America's largest Ferrari collections, Luc Poirier. Luc, thanks for being here.
My pleasure.
You know what? You started out in trading cards, in particular hockey cards. I've started to collect hockey cards with my boys who are 7 and 5, and I'm glad and wonderful to see where you've ended up as a result of this. But take me through how you started this and, your first foray into really what was your first business.
Yeah, I started with hockey card at 14 years old. I wanted to play hockey in my city, and my mother, I'm living with my brother, with my mother, and we don't have any money for the equipment and the inscription. So I started to sell cards, and I understand the difference of the market. So in Quebec, everybody wants a French hockey player, and outside Quebec is mostly English hockey player that mostly clients want. So I trade. Pardon?
No, I'm just saying. No, go ahead. Yeah, go ahead.
Okay. So I understand the market change, and I start to resell cards, and after that I resell T-shirt and hat from American sports like football, baseball, basketball at 16 years old. And after that, at 18 years old, I started a BBS. BBS is a bulletin board system. It's the former internet things. So I started with that, and after that, I start to buy real estate. But I'm become rich because of the real estate, not because of the cart and T-shirt and so on.
Yeah, so talk about your real estate business too, and getting to a level where you were able to now, to buy all of these. I've seen the list of your cars. It is an outstanding list. And so being able to do that, but just talk about the explosion of the real estate business.
Could you repeat, please?
Yeah,
Sorry.
just talk about expanding your real estate business. What was the key to that for you in order to, to keep expanding and making all that money?
Yeah, I'm started with doors like apartment rentals, but after around 26 years old, I sold everything, my apartments, and I started few years ago to buying lands. So I buy lands, big lands, and I develop the land. So I put street and sewer, water, and I resell those parts of the land to different constructor. That's what I'm doing right now. Mm-hmm. Yeah.
And then the Ferraris too. Have you always always been a car guy? Have you always loved those cars? But now you have close to 40 of them, and what sounds like one of the best collections ever.
Yeah, for sure. When I was very, very, very young, like 5 years old, I was my eyes blowing when I see a Porsche or Ferrari not on the street, because nobody has that at that time in Quebec. But mostly in the movies or something. So I started to love cars at that age, 5, 6 years old, and it's a passion for me. So when I had money, I buy at 16 years old my first Porsche at 16 years old, and I continue. I never dreamed at that time to buy a Ferrari, because Ferrari is the next level over a Porsche. So at that time, I didn't think I will be able one day to buy a Ferrari. But around 24 years old, I has enough money to put a deposit on a brand new Ferrari. And 4 years later, because at that time, the delay for receive a new Ferrari is 4 years old. Mm-hmm. 4 years. So I waiting 4 years for my first Ferrari. It was a Ferrari F430, 2004, my first one. So since that time, I bought new minimum 80 Ferraris, new Ferraris. Yeah.
It's fantastic. And I'm sure that you're going to have a great weekend, too, at the Canadian Grand Prix this weekend in Montreal. So enjoy that. Luc Broy, your entire story, too, as well, is at Bloomberg.com. Thanks so much for taking a few minutes with us today, Luc. Thanks so much. Well, up next, Larry the Downing Street Cat has had 6 prime ministers. Will he have a 7th? Stay with us. Keir Starmer's 2024 landslide became a sinkhole in under 2 years. Bloomberg Originals explains how British politics collided with economic reality, fueling a revolving door prime ministers.
Spare a thought for 19-year-old Larry.
Larry, the Downing Street Cat, has outlasted David Cameron, Theresa May, Boris Johnson, Liz Truss, Rishi Sunak, and maybe now even Keir Starmer.
The knives are now well and truly out.
Dozens of MPs call for the UK Prime Minister to get ready to step down.
And this is what's got people asking, what on earth is going on in the UK?
If you speak to any of the last few prime ministers, they might tell you that Britain is ungovernable.
Well, except the current one.
No, I don't think Britain is ungovernable.
The rhetoric stems from a reality that over 7 years, Britain has churned through 5 prime ministers, while lack of growth and a cost of living crisis have stubbornly stayed put.
Voters and other politicians are so impatient to see change and improvement that the immediate thought goes to, well, let's change the Prime Minister.
Are you going to stand for leader?
And would-be successors are lining up again. But voters may be overlooking another permanent presence in British politics, less furry than Larry and much less forgiving.
You're seeing the bond vigilantes waving their pitchforks and coming out for blood.
Wow, gilts are really exciting.
Oh, they are. And here's the proof. Britain saw the yield on 30-year government bonds, known as gilts, hit new highs in May.
Although this is primarily a political battle, there's no getting away from the fact that the bond market looms large over the whole drama.
So this is a story of how Britain's political crisis collided with economic reality, what that means for Keir Starmer, the country, and Number 10's longest-serving resident. How quickly everything can change.
14 years of Conservative Party rule has come to an end.
It was a landslide victory for Labour back in 2024.
A huge opportunity for the left of British politics to govern for the first time since Tony Blair and Gordon Brown.
Less than 2 years later, the landslide looks more like a sinkhole.
The UK has just wrapped a pivotal vote that could put Prime Minister Keir Starmer's party and his job at risk.
Will you resign, Mr. Starmer? Are you just squatting in number 10?
The local election results in May were dire for Starmer's Labour Party, losing seats left, right and centre, literally. The right-wing threat from Reform UK, led by Nigel Farage, a left-wing threat from the Greens, led by Zach Polanski. Labour turning on itself, blaming the leader for not being able to connect with voters.
Keir Starmer hasn't even had 2 years in the job, and people have already decided they've had enough of him.
So what went wrong? The first thing to remember is that Starmer wasn't exactly elected on a groundswell of public opinion in his favour.
It was really a sort of negative vote against the Conservatives after years and years of chaos, really, that brought Brexit, Boris Johnson, Liz Truss roiling markets. People had had enough of the Tories and wanted a change, and that was the pretty much one-word slogan of Keir Starmer's election campaign.
Then came the fiscal reality check. Within days of taking office, his Chancellor, Rachel Reeves, said public finances were far worse than feared.
And she came out with a very controversial cut for pensioners, which caused a battering for the Labour Party in the opinion polls, from which they've never really recovered.
Next came £40 billion of tax rises focused on businesses. It prompted critics to argue Labour had put its growth pledge at risk in a way that would ultimately impact jobs. And it did. Unemployment has risen since Starmer took office. Both payrolls and the number of vacant jobs have decreased, and businesses have pointed to higher employment costs as a reason.
The other events preceding those local elections that weakened Starmer have been the revelations around the Peter Mandelson ambassador to Washington and his dealings with the disgraced financier Jeffrey Epstein.
A Bloomberg News investigation revealed in 2025 that Peter Mandelson's relationship with Jeffrey Epstein was far deeper than anyone had previously known. Starmer sacked Mandelson off the back of that story.
I should not have appointed Peter Mandelson, and I apologise again to the victims of the paedophile Jeffrey Epstein, who were clearly failed by my decision.
Behind the very visible Westminster drama sat a harder problem. Rising welfare costs, weak productivity, and precious little spare cash.
The UK has been a low-growth economy for some time now and really has struggled to get itself out of the situation since the global financial crisis.
In that time, there was this, then COVID, Ukraine, the energy shock, that infamous Liz Truss mini-budget, and now the war in Iran.
It's left Keir Starmer facing really almost insurmountable challenges.
Chief amongst them, this. The cost of long-term UK government borrowing had been falling. Now it's risen to the highest level since 1998. So why is that so consequential for ordinary people?
So for consumers, a rise in government borrowing costs matters because if the government's spending more on servicing its debt and paying its interest costs, that's less money that the government can be spending on things like investment and boosting growth.
And some analysts are now pricing in the chance that Starmer is replaced by someone more willing to borrow into already expensive markets.
There is a high demand for spending given the geopolitical situation, a requirement for higher defence spending, and yet taxes at levels not seen since the Second World War.
It's been a tricky couple of months for government bonds globally. That's been the case since the outbreak of war in the Middle East. That's fueling new fears over another inflationary wave, and that's seen government bonds from all over the world sell off sharply.
You see Japanese yields at the highest level since 97 on some maturities, in the UK since 98, German yields 2011 on some maturities again, the US the highest close so far this year.
A worldwide issue then, but one being felt acutely in Britain. These are 30-year yields for each of the G7 nations since January. They're all elevated, but it's only when you add the UK that you begin to see the increasingly costly premium that investors are demanding to lend it what it needs.
Global bond yields are higher as a reaction to higher expected inflation because of higher energy prices, but then layer on top of that the political uncertainty. All of that making UK government debt less attractive to international investors.
And Britain comes into this having borrowed a lot already.
The UK debt, if calculated relative to economic output, is above 90%, which is pretty bad. The more debt you have, the more vulnerable you are to rising interest rates because that makes it more expensive to issue and to service your debt.
More spent on interest means less left for anything else. In the most recent fiscal year, the government spent about £100 billion on interest alone. That's pretty close to the UK's entire annual education budget. And this is exactly what people wanted to see change. More money for crumbling institutions. But it gets worse.
The UK has a chronic inflation problem.
Prior to the war in Iran, the Bank of England had forecast inflation to do this. Yes, hit a 2% target for 2026. That made interest rate cuts look possible and could have eased borrowing costs over time for people and government alike. But in March, it was revised upwards.
The Middle East war, oil prices have been higher, inflation is higher in the UK as an importer of energy.
To be fair, the economy has grown on Starmer's watch. But after inflation, wage gains have dropped. So for many households, growth still feels theoretical.
All of that pressure on gilt feeds into the Westminster bubble that we seem to be seeing with repeated prime ministers, though I would point out this is somewhat different. For Starmer, the bond market seems to be defending him.
The bond market really wants Keir Starmer and his Chancellor of the Exchequer, Rachel Reeves, to stay. This market thinks that they are the fiscally disciplined politicians. They've sort of set out these fiscal rules and reiterate time and time again that they are going to abide by them.
Whoever leads Labour will command a majority in Parliament, but only do so until the next general election, expected in 2029. And inside the party, attention is already turning to one man.
The key person over the coming weeks and months, and potentially years, in the Labour Party is Andy Burnham.
He's decided to leave his job as Mayor of Manchester to stand for a parliamentary seat in Westminster, from where he's expected to challenge Starmer for the top job. And he has a very different view on how to solve Britain's fiscal deadlock.
He said that Westminster shouldn't be in hock to the bond market.
That really spooked investors because it suggested that he wouldn't really care if bond markets sold off. He would just sort of plough ahead with big spending plans.
Which, even though he's tried to walk those comments back, is something that the bond vigilantes will have a hard time forgetting.
The rules are there for a very important purpose, to give confidence to investors. The rules will stay in any context.
The best case scenario for Labour is that voters take to Andy Burnham and that he has policies that are bold enough to make a difference for the country. The difficulty is lots of these economic problems particularly are structural and immense and very difficult to change in a short period of time. And also the next Prime Minister will be operating let's face it, in the world of President Trump, where there is constant international instability, and there's really very little any Prime Minister can do about that.
So whoever walks through that black door next will discover the same thing. Changing the PM doesn't reset Britain's problems. And perhaps that the only truly safe route to securing a long-term occupancy of this place is to be a cat.
There you go. That does it for today's program. Want to thank you for being with us today and joining us this week. Have a great weekend. We'll see you on Monday.